Maverick Traders, welcome out to your trading room as we prepare for the week coming up, September 29th through October 3rd. Corey here with you. We're always going to take you through meaningful news in the markets, what's moving, various sectors improving or getting worse. We're going to talk through those, and then we're going to highlight some new ideas. We've got bullish, we've got bearish, we've got neutral ideas for you. As we take a look at last week, it was a little bit of a pullback week. Nothing major, but the markets pulled back slightly. The economic news that was most closely watched was the inflation numbers, and on Friday we got core PCE came in as expected at 0.2. The markets kind of breathed a sigh of relief and said, okay, this is what the Fed is watching most closely, is inflation, to determine whether they're going to cut rates in the future. Bond yields and US dollar continue to rise. This is 2 weeks in a row. The bond market and currency markets are saying, hey, not so fast. We're not going to really cut rates. They did back up a little bit on Friday on the inflation news. So markets are certainly wanting the Fed to accommodate, to continue to cut rates, and that's something that they're watching closely. As we said, core PCE was watched here on Friday. Final GDP numbers beat expectation in the U.S., came in at 3.8% versus the 3.3% expected. Otherwise, just nothing too major to talk about. Now, as we look at markets and their performance, it was, like I said, a mild pullback. The Dow, S&P, NASDAQ, Russell, all down in the neighborhood of 0.5%. Gold, oil, very strong. Gold up 2, oil up 4. So it was really a rotation into those commodities, into the precious metal space. That picked up some nice buying pressure. And, you know, it's interesting. Gold's been on a tear, but crypto's been left behind. That was the opposite of what we'd been seeing for years. So right now, there is certainly a rotation into precious metals, and it's not being seen in other similar assets like crypto. So that's worth noting. Now, if we look at the S&P 500 chart, you'd say this looks like a standard pullback. There's just nothing to this right now that is problematic. We pulled back, checked back to the moving average. That is perfectly reasonable and normal. And then on Friday, on the back of the PCE numbers, we pivoted higher. So notice we established a higher high, higher low in the pivots, or a true pivot point, change in direction. So we're in a bull pullback, and now we've started higher. What would be problematic would be if we were to now come and have this pullback be a failure. Imagine, if you will, maybe the market does this and kind of chops around, and then for one reason or another started to just break down below these levels. Then you would have cause for concern. That's nothing that seems most likely right now. It looks like a standard bull market. We're in a bullish pullback. You want to buy the dips and continue to ride this wave. So if the market tells us otherwise, we'll pay attention. But for right now, standard bull pullback. Now, if there was some reason for caution, it's that this rally hasn't really broadened out. So this is a chart of the equal weight S&P 500, meaning if all 500 companies were equally weighted, if the bottom 10 stocks were weighted as large as Apple and Google and Facebook, well, Meta now is the symbol, right? And Amazon and Nvidia, if those bottom 10, if all of them were equally weighted, you'd see the market's in a range-bound market, that it's not really going anywhere. So what does this tell us? Well, it tells us that this is not a broad-based rally, that not every sector is participating, that this is being led by the biggest market cap stocks. Apple is strong, Nvidia is strong, Google is strong, but the bottom 400 stocks are not really that strong. They're more choppy. So AI, the AI related trade, is the driving force. Now, half cup full, half cup empty, you got to determine that. I would say if you want this to be a raging bull market, Friday was a good start. Friday's candle was an expanded range candle. It was up on a percentage basis very nicely, up 1% on the day, on the back of, again, what was a little bit of a deeper pullback. So it looks like we're going to go up here and challenge that high point, which makes perfect sense. Again, we're in a bull market. And if this breaks out to the upside, that means that the rally is broadening out. That means that other sectors that were not participating are now starting to catch a bid. Because right now, as a trader, you've really had to focus your attention on the very best stocks. And you can't even contemplate buying things that are lagging. This, for the first time, kind of looks like, well, maybe some of the laggards will catch up. Maybe some of the energy stocks. We'll talk about how energy had a bit of a shift this week. We know that oil was up 4%. Well, if you look at the heat map, it's very green here in energy. So if we were to look at one area of the market that was most green for this week, it was the energy related stocks. So if I were to look at this and say, is there anything to glean from this past week? It would be that energy is the place to be. It's the strongest, best looking sector here based on last week to this week's change. Other than that, a little bit of a mixed bag. Certainly some weakness in comm services and the big names, Meta, again, the formerly Facebook, Google. Amazon had a really rough week. Oracle, which had been on fire, a bit of a rough week. But, other than that, I'd say we had a little bit of a broadening out of the rally, specifically in energy. So as we prepare for the week ahead, looks like a textbook bull pullback. We know that AI and tech have been driving markets. NVIDIA announced a $100 billion project partnering with OpenAI. OpenAI is the creator of ChatGPT. Well, did you know that since ChatGPT launched in November of 2022, 80% of the EPS growth in the S&P 500 and 90% of capital expenditures have come from AI stocks? That means essentially everything else in the economy, so-so. 80% of the growth, 90% of the spending is coming from AI related stocks. This is an AI bull market. The naysayer would say it's an AI bubble. Either way, it's AI that is pushing markets higher, and we're seeing it in the way that these large cap tech stocks are spending. Look, NVIDIA is not batting an eye. They say we need to build out a $100 billion project for data centers. We're going to do that. All of these companies have built out or starting to build out nuclear plants to service their future energy needs that will cost tens, even hundreds of billions of dollars over time, and they are welcoming that because they are in an AI race and they want to win. So there's a little bit of a seasonality caution. Does the buying of the dip continue? We get into the October time period. I think it's still a bull market, but we do know that seasonality is usually not so good in that September, October time period. On Monday, you get the RBA announcing rates. They're expected to keep rates unchanged. In the U.S., we get ADP employment and ISM manufacturing on Wednesday, which leads up to Friday when we get non-farm payrolls. Always the first Friday of the month. And when you look at the Fed's two major mandates, we've got inflation, price stability on one hand, we've got full employment on the other. Well, we just saw inflation numbers that came in okay. We'll see what the non-farm payrolls come in at. The revisions to jobs have been astounding. They've revised down 1 million jobs they previously reported as having gained. So the data has been terrible coming in. The revisions have been worse. They've been writing down the numbers on how many jobs they thought there were. Interestingly enough, it was the downward revisions to jobs, though, that helped push the Fed towards cutting rates. On the weekly outlook, back to a positive expectation. Last week we had it at -1. That was a pretty good call given the pullback. We're coming up out of the pullback. I think back in the resumption of the bull market unless proven otherwise. Let's take a look at some sectors here. So as we look at performance, it was a week for energy. Utilities were very nice as well. Everything else sideways to lower. So not a great week, again, given the pullback, but energy and utilities loved it. As we look at these charts together, you're going to note the big improvement in energy, and we upgraded it accordingly. So let's take a look here. First, utilities had been in a little bit of a choppy market, but starting to come up out of that. If you look at this price action, we're now making that series of higher highs. The next pullback should establish a higher low, and the zigzag should continue higher. So utilities we have upgraded since last week to a +1. They were more of a neutral last week. Communication services still pretty much the same. This is a standard bull pullback, so I don't want to call it anything other than, hey, it looks pretty solid. We pull back to the moving averages, we pivot higher on the upward pivot. There's even an uptick in volume. That's pretty good price action there. Real estate. Real estate is choppy. Real estate, you can see it in the moving averages, just bunched together, crisscrossing. This is not a market or not a sector that we want to make a big bullish or bearish trade in. It's just a zero. So we'll be looking and in fact adding a new trade in the real estate sector. Healthcare, disappointing week. Breaking down this week, really underperforming, so we had to downgrade that as well. It's not sharply lower, it's not in a runaway downtrend, but certainly a little bit of a downgrade. So from a mild upside expectation to more of a neutral expectation in healthcare, now at a 0 rating. Industrials, well, crisscross moving averages. See how the 20 cross below the 50? Both bunched together, both sloping sideways. This is the epitome of just more of a 0 type of trade. We were below the moving averages a day ago. We got back above them today, but ultimately just choppy price action. What would change that? Well, you really need to surge out of this range. Either you break higher or you break lower. This could be a candidate for such a breakout because it is getting wound tighter and tighter and squeezed sideways. But for now, just more of a neutral. Can't really make a big bullish or bearish bet on the industrial sector. Financials, a little bit of a standard bull pullback, but I would say a little weaker. Notice how it got below its 20. So many other sectors in the market itself did not get below the 20. So a deeper pullback, a little bit more weakness in financials, nothing to be too concerned about, but not quite as bullish as it was. So we took that down a notch and +2 rating, expecting still an upside move, but not as strong as some of these others. Consumer discretionary, this one is pretty standard, pulled back to this prior swing high, old resistance, new support type of idea. Nice upward pivot on Friday. Still looks pretty solid in consumer discretionary sector, so nothing problematic there. Consumer staples, on the other hand, look at the difference. Consumer staples are the things that you're going to buy whether the economy is good, bad, or indifferent, right? These are your toiletries, your alcohol, your cigarettes, all of these sorts of companies, the Costco's, the Targets, the Philip Morris, the Budweiser, and so forth, and they're just struggling. You look at charts of Coke and Pepsi, they've certainly been on our bearish list for some time, so that's going to continue as long as it's trending lower, and right now that continues to be the case. Technology, if you look at all those sectors, tech still holding up relatively well. Notice the pullback to the prior pivot high, old ceiling, new floor, right? Old resistance, new support, and pivoting upward today. So good price action in technology. Still continue to maintain a +3 rating. One of the worst downgrades this week has to be materials. They really got sold off hard and on an uptick in volume. not great. And I would say the material sector certainly needs to be considered for bearish trades. Stocks like Freeport McMoran and others just getting hammered. So when you look at that chart, we're going to add a bearish trade in materials. Given the sharp move lower, it was probably the worst sector reversal this week. And the best was energy, the strongest and nicest breakout to occur. Energy had been in a range bound market. I didn't draw that line very well, but had been in this choppy range bound type of idea here. And the upside breakout late in this week looks great. Again, oil was up in the neighborhood of 4%. This was a nice ascending triangle pattern that it broke out from and should continue to work its way higher here in the future. So we're going to have a trade idea in the energy space. Again, nice upside breakout, certainly worth the upgrade. All right, so as we look at the sector results here, the big downgrade this week was materials. That one looked worse than most. And the big upgrade was energy. That one was the biggest outperformer. So those were going in two different directions. Otherwise, there were some slight changes, but the strongest areas continue to be tech and consumer related stocks. And those are the stocks that are loaded with large cap big tech names, right? They're not all in the technology sector, though. Nvidia is in the technology sector, Microsoft is, but other stocks, Apple's in the consumer sector. So, and we think of it as a big tech name, but it's really that consumer discretionary. So they're spread out amongst those sectors, but that's the driving force. The weakest sector continues to be staples. So it's an AI trade. Now, here's our current positioning in the portfolio. We're going to lose 4 positions over this weekend. Consumer staples hit an expiration, a technology trade, comm services, and utilities. We want to continue to have really a bullish outlook. And so we're above the 20, we're above the 50, they're upward sloping. We continue to be bullish. And if you're bullish on the markets, as we are, then you suspect that, well, we want to have a more bullish posturing. So as we look at it, this is the ideal setup across our trading spectrum. We don't always have that many trades, but we'd want it to be spaced out something like that. And so as we come in, well, we're going to add 4 new trades. We're going to add a new bearish trade in materials. We're certainly going to add a nice energy trade to the mix, a tech name, and then a sideways trade in real estate. Let's take a look at those candidates. So here's the possible trades. We're going to start with real estate. And this one, we're going to go out a few weeks. We're going to go to October 17th, monthly expiration. And the trade we were looking at was a put butterfly. 120, 125, 130 put fly. Let's look at the chart and make sense of this together. So here's our levels. And if you look at the put fly, 120, 125, 130, the structure of a put butterfly is basically the closer you are to the middle of the range, the better. But our profit zone, this trade is going to come out to maybe around 105 debit, something like that. So that's our max risk. That means that our max reward, since it's a $5 wide spread, is $3.95. So if we were to look at this on a risk graph, your risk graph in a butterfly always has the flat bottom, then it goes up, then it comes down like that. Well, you'd have a break even in here, but our risk is only around $105 and our reward potential is up to $395. But the good news is you don't have to be at the pinnacle to make some money. Right here you'd be up $300, $200, $100, $50 or whatever. You'd be up almost 400, 300, 200, 100 and so on. There's a range there. So you could even draw this risk graph somewhat with the chart, and you'd say, okay, if it's below here, or above here at expiration, we're going to have a loss. But there's a big profit zone in here that connects up to 105 or 125 per share. So that's kind of how the risk graph would look related to these stock prices. So we're looking at that again, 130, 125, 120 put butterfly. What's going to happen is this stock is going to move away, but we would anticipate choppiness can bring it back. So let's imagine it rolls over. Well, there can be a rally that pulls it back up, and then that pulls down. And by the time you waste a couple of weeks, you can still be within this range. That would be the ideal circumstance. The technology sector got a new bullish pullback in Palo Alto. The idea here, just a +1, just a mild bullish target. October 10th was the expiration we were looking at, 197.50, 202.50 spread. This would give us a decent risk to reward given the higher probability of success. So all this trade needs to do is finish above 202.50 and we would have max gain. That's essentially where it is here. So if it goes up just a little bit, we're at max profit. Now, if the stock goes down, then we were wrong about the trade, and of course we'd expect to lose money. As we look at this structure, it's just a simple bull call spread that looks like that. Your risk to reward, you'd have a break even in here, and the way it's structured is, well, if the stock is up in price, you'd be at max gain, and if the stock goes down in price, you could hit max losses. That's the essence of the structure. We just want the stock to go at least mildly that way, and we'll make some money. We've got a trade in materials, which is basically the inverse of what we just talked about. This is a stock that's in a downward trend, so we're looking at this is a bear rally short setup. October 10th expiry, 142, 138 bear put spread, just targeting a mild downside move. It's literally almost the exact opposite expectation. First, the technicals. Notice the bear cross, 20 has crossed below the 50, the downward slope and the price action below it. We're in a little bit of a bear rally, which brings us back up to resistance. Notice how it failed here, hitting here. We would expect a little choppiness and then a rollover. All we need is for this stock to finish below 138 at expiration, and we would have maximum gain in the trade. So stock moves lower, we're going to make money. We'll do smiley face. Stock goes a lot higher, which is not anticipated. Well, then you would have max loss. We would position size so that max loss is a small percentage of one's portfolio. Energy, the best sector this week, and for good reason. We'll look at the chart, but we're going to play this as an upside breakout in ExxonMobil. October 10th expiration, 114, 118 bull call spread. Again, we don't need a lot out of the stock. We just want it to go a little higher from current prices. First, the chart, you can see resistance right here and the upside break was in something of an ascending triangle. This one at 118 or higher, we have max profit. So that's all we need to be, is just finish at 118 or above. It may get choppy. You could see a little consolidation, but this is certainly a stock that should continue to work its way higher over the next couple of weeks. And we don't need a lot out of it. We just need a little bit more bullish upside for max gain. In conclusion, look, this is the epitome of a bull market. There is reason to be a little bit cautious with the September-October seasonality, but right now it is a bull market, and we shall treat it as such until it decides to change direction or change its trend. We'll stick with it. Hope you've enjoyed today's trading room. Have a great week, everyone. We'll see you next time.